Hi, welcome to Market in a Minute on tax day, huh? Probably one of my least favorite days. But thank you for all you CPAs out there. A lot of hard work to all cram into about 3 months of time. You guys deserve a vacation. Want to talk about the big picture, okay? So there's 3 points we want to make. One is the economy was ready to go into recession in 2024. Secondly, the tariffs they've been handled so poorly. It really makes me mad how these tariffs were handled. Thank goodness they're kind of waking up to that fact and starting to work through the issues. But I got to give Trump an F minus on how he handled these tariffs. But maybe it'll get better. And then the incentives coming in the back half of the year are going to be probably really positive for the economy. But we got to get through these next 2 quarters. And then the dollar as the reserve currency. There was a whiff in the market recently, given the dollar is going down and rates are going up, that we're losing the dollar as a reserve currency. I don't think that's possible, but thank goodness the Treasury Secretary Bessent, figured this out and is probably putting plans in place. I have no idea what they would be, but I think the fact that he's negotiating these deals, these tariff deals, is a big positive. Otherwise, Navarro is a big negative. Big negative. He's too restrictive. He's too narrow-minded on how to do this. Bessett's the right guy. Biden last year, okay? So we were about 6.6 trillion, still a crazy number, right? We ended the year at 7.1 trillion. So in spending, federal government spending, he added $500 billion in spending. And you can see, we talked about this a lot when it was occurring, this acceleration of spending as we went into the election. So otherwise, the economy wasn't going to show any growth last year. So we had 2.8% GDP growth. The 500 billion, accounted for about 1.8% GDP growth. And you would expect that there would be some sort of multiplying effect with $500 billion coming into the economy. So who knows exactly what it would have been, but we're guessing that we would have been flat to probably down a little bit in 2024 without it. Okay, that's the backdrop. Now here comes the tariffs. We think the tariffs on surface, kind of 25% tariffs, kind of looks like a 1 to 2% hit to GDP. Maybe nothing significant in terms of inflation. Now this is really interesting. So this is kind of what's in the works that we hear. There's a big parts manufacturer, supplies the three big OEMs on their parts. So General Motors, Stellantis, and Ford, right? So they have a good view of what's going on. They say that the government is going to provide some assistance in a grace period to get these parts and get the cars manufactured in the U.S. Hopefully it's 2 to 3 years. I mean, I think they're probably going to need 3 years to kind of really get everything situated. 90 days isn't even close to being helpful, but I think that will allow them to get the plan in place to move forward. That plan makes a lot of sense to kind of slowly do this over time and do it properly. So, somebody in Washington is working on this and it's coming up with a better idea than saying, okay, the tariffs in place, that's just the way it is. Um, Now here's the big picture. Okay, so there's roughly $918 billion in net trade deficit. So we import almost $1 trillion more than we export. That costs the U.S. in terms of GDP about 3.3% per year. That's a lot. So as we narrow this deficit, our economy is going to grow faster. So that's a real big positive for our economy as we resolve these trade issues. So looking out a couple years, we see that this can turn into a very nice positive. But the way it's being currently handled, it was a misstep, and I think they're maybe going into the right direction currently. Now, financing the debt. So this is the foreigners. The foreigners are financing almost a third of our debt. So we have to keep, this money happy. Otherwise, if it disappears, what is that? That's about $12 trillion that we're going to have to come up with. So we get a collapse in the dollar, we get higher interest rates. So this is a big issue. So it's good that Besset is doing these negotiations, hopefully trying to keep this money intact here in the U.S. So just keep in mind, the last time we had a dollar issue, a big dollar issue, was the Friday before the crash in 1987, when James Baker came out and said, "We're not supporting the dollar." Interest rates were too high relative to stock prices, and the stock market corrected all in one day. So this is something we want to avoid. Now, the bond market, okay, so speaking of the devil, and what's going on with the dollar, so you can see here what spooked the markets. We went from 4% on the 10-year Treasury to 4.5 very quickly. Now it's backed off a little bit on Monday, so that's good. The credit market has weakened quite a bit. So the junk bonds have moved up about 2.5% relative to where they were on the spread with the treasuries. So it could go up a lot higher, but that's kind of a warning sign that there's something broken going on in the bond market. So it's good that we are maybe quickly resolving some of these issues on trade, and hopefully the markets will become more convinced that we're not going to have negative GDP growth and higher inflation. So the two don't go hand in hand, right? So if you have negative GDP growth, you're going to get lower inflation. That's what we want. The inflation numbers that reported last week, they were awesome. They were good. They were negative, not just down, but negative. So that's kind of going in the right direction. If the tariffs were handled properly, it becomes a non-issue, and then we get the stimulus coming in the second half of the year. So it should be a good year in the back half for GDP growth, with the stimulus in place. Okay, so the technicals. We're in a bear market. So by definitions of a bear market, down 21% is what we fell from high to low. We haven't regained the high, not anywhere close to it, but we're close to being halfway there. So 5,500 on the S&P is halfway back up. And so we're 5,400 on Monday's close. So I think we're kind of in that range of 5,500 down to 5,000. So on a closing basis, we got a little bit below 5,000. We think we're going to be in that range for a while. We'd love to see a breakthrough that 5,500 level and make a run at 5,700 level where the 200-day is. If we can close above the 200-day, everything kind of turns into a much more a nicely positive technical picture. So just keep in mind, we are in a bear market. We're probably at this point in time, we think we're in the upper end of the range of a bear market, of the trading range. And the fact that the VIX got to 57, that probably set the low for a while. So we're pretty convinced that that 57 might be kind of the low that was put in place. I've seen the VIX up to 80, rarely above 40, and so we went nicely above 40. And as we mentioned last week, we thought the VIX being at such a high level probably was a pretty good indicator that we may have hit at least a near-term bottom. And we had a big move right last week, a big move off the bottom. So we'll just follow where it goes from here, but we're feeling a little bit better about the technicals, a little concerned we're at the upper end of the range. Want to see a breakthrough that 5,500 level. If not, then we'll maybe come down and retest, the 5,000 level. Okay, in terms of wealth management, so what are we doing, right? So the tariffs are a problem. We already know that. Trump gets an F minus. Maybe he can pull it out on the final exam, right? And maybe get that grade up to a B or a B plus. But he did a horrible job on handling these tariffs, and we think that the guys he's associating himself with were probably the main cause of it. Bassett probably being involved really improves things going forward. So the bottom line is, what we're really trying to do, and I really like this, is bring down this federal debt as a percentage of GDP. This has to stop. So if this doesn't stop, we lose the dollar. Okay? So this has to stop, and we have probably a pretty good plan in place of having the tariffs in place, balancing out trade, so accelerating our economy some, and bringing down federal spending. This probably should hold and improve over time. So, with the dislocation in the bond market, what's happened? Some of the income stocks look really good. We really like agency debt, just in general. It trades at a really nice premium to the government debt, so treasuries. So, agency is a mortgage REIT that focuses on agency debt. The stock came down from 11 to about 8, so it's now trading at a nice discount to its book value, which is kind of liquidation value, a nice discount, and the yield is 17%. So this is a good time to snatch that one up. That's hard to beat. How are you going to beat a 17% return? Kind of hard. Cherry Hill Mortgage, okay? So this is a small cap mortgage REIT, similar to agency, but small. It's I hear from multiple different places around the street that they, the BDC, or excuse me, the mortgage REIT analysts really like this particular company. At a 24% dividend yield, that's just too high. So for our accounts, we really like that one, 24% dividend yield, and there's nothing wrong with this company. Runway is a BDC. Again, good sponsorship. So Runway was actually down quite a bit. It got clocked. Okay, there's a large institutional shareholder that's getting out of the shares. They've owned it forever. Their funds are liquidating. They knocked the stock down quite a bit. It was 11, 12 bucks. Now it's down to about 8. Popped a little bit to about 9. There's insider buying at Runway. So we see some insiders buying the stock. This is the institutional seller out there. They're liquidating their funds. This is an opportunity to buy a really good BDC with a 16% dividend yield. On average, where we're seeing opportunities is in the closed-end fund space as well. So there's a lot of really compelling closed-end funds selling at nice discounts to their net asset value. So that's kind of a cushion. In general, we see about a 7% discount to NAV and over a 10% dividend for closed-end funds. And this is kind of the benchmark for BDCs, PCEF. So that's the Invesco closed-end fund. It's an aggregate of all the a number of different closed-end funds. It gives you a good sense of what's going on in the overall markets. So we see tax cuts coming. Government spending is declining and will decline further. Okay, maybe that has some more negative impact on GDP, but ultimately it relieves the economy of this drag that's sitting upon it. So actually becomes a positive in time. Deregulation is coming. That'll really help speed things up. I tell you, this has been a problem under the Biden administration. You start to deregulate, meaning cutting the time and all the nonsense paperwork that goes into getting approval on important things. Will be greatly helpful to the overall economy. So what to do in this environment? Be protective of your portfolio. At a minimum, put stop losses in place. However, kind of what I'm doing right now is I took the hedges off. That was an opportunistic thing to do as we got some of this big rally last week. Okay, we do have a little bit of hedging in some of our portfolios, so that's kind of sitting there. But if we start to roll over, we're going to put the hedges back in place. But right now we're enjoying a nice ride, and we picked off some really good companies at attractive valuations. So we're dollar cost averaging in on those securities. As you guys know, I like, biotechnology companies. Pfizer dropped their obesity drug today. Remember Viking? That's the one that we were in mostly around, the $2 range for our clients, and the stock went to as high as $69, where we completely exited the position. And it actually went higher than that, but we exited around $69. So big return, right? Stock's back into the low 20s. With Pfizer exiting, we think Pfizer's got to do something. They got to be in this space. They're too large. They have to be in. So we think that Viking makes a perfect fit for Pfizer. So I'll leave it at that. Thank you to the CPAs out there. If you ever have any questions of what we're doing, just ping me. If you want us to help you with your portfolios, again, just contact us through my website, Patrick Adams CFA, and then also sign up for a hard copy of Market in a Minute. We'll send that to you every week. But the best thing to do is to be on the video, so it's much easier to deliver to you. Take care.